All right, Uber just reported they beat on earnings and they beat on revenue. They were expected to lose 18 cents per share. They made 29 cents, and they were expected to get $8.48 billion in revenue. They did 8.61. Now, let's pull it up first in our software, because right now Uber is up about 1%, but it was up a lot more earlier. It was up 3.5%. I think it was up even more than that pre-market. So this is their actual earnings release, and there's something I really want to focus on here. The one thing I want to focus on before we look at the other data, net income was $595 million, which includes a $756 million net benefit due to net unrealized gains related to the revaluation of Uber's equity investments. What does that mean? It means they made investments in other companies, and those investments were up $756 million last quarter. And the SEC's new rules, which Warren Buffett and Charlie Munger and I, not trying to put myself in their category, have said is a stupid rule. But if the stock that you've invested in has gone up in value, you need to report that as a net gain on your P&L. So if I own stock in XYZ Corp at $100 and it goes to $120, I need to report that $20 extra as a gain in my net income. It's not really net income, it's investment income. But I want everybody to realize that that's a big gain. That actually, if they didn't have that, would have put them in a loss for the quarter. That's something very important. But let's go talk about the positives of Uber. Ready? Gross bookings up 19% year over year to $30.7 billion. Okay. Revenue grew 49% year over year. So bookings grew 19%, but revenue grew 49% to $8.6 billion. That's a huge, huge number. Now, everybody knows I don't really like EBITDA at all because of the depreciation part of it. People sit there and they say, oh, EBITDA is important. It's not. It's a manipulation in order to justify a profit level. However, very capital intensive businesses are going to show a higher EBITDA than they actually should show. That's very complicated to hear right now, and I don't want you to focus on that. But I only say that because I want you to realize that when I look at this EBITDA, I look at it and go, I kind of chuckle. But adjusted EBITDA of $665 million was up $579 million year over year. That is huge, okay? Net cash used in operating activities was $244.7 million, and free cash flow was $303 million. Now, for the year, free cash flow was $1.1 billion for the full year of 2022. Now, I want you guys to see this tweet I saw today. Now, if for those of you guys who are on Twitter, follow me because my Instagram and Twitter are the same name. Instagram is more of my personal life. This is more of my Twitter I talk about investing. I talk about 95% of my tweets are investing or non-personal related. But here's something very interesting by this guy. I've never had an Uber position, but I want to point out that it claims $1.1 billion in 2022 free cash flow, but stock compensation was $1.8 billion. Now, this is it's getting way more in the weeds. And I'm not trying to pull out the negatives of things. However, it's about looking at everything and saying, what's really behind these numbers? This does matter long-term. If we keep issuing stock comp and stock comp and stock comp, it is diluting people. It's diluting the company. So these are just things to factor in looking at Uber. Now let's look at Uber's history on our software. Let's look at the income statement. Now the software uploads, but let's go look at the last 12 months. So not including last quarter, $29 billion in revenue versus 14.8. Now, obviously this one had to do with COVID, but there's growth and there's great growth. And there's also great losses. Look at these losses. Guys, the Uber CEO last year said things have changed. Things have changed in the market. They no longer care about growth as much as they care about free cash flow. So they're going to focus on free cash flow. So I like the fact they're doing that. Plus, Uber's a great brand. We use Uber as a verb now. These are the very big positives for Uber. Now, it's very, very young still. I don't want to make it seem like it has some major moat. However, it has the makings of a moat, if you ask me. Why is that? Because you use it as a verb. Hey, I'm going to Uber here. I'm going to Uber over there. I'm going to do this. Nobody says, go get a Lyft. I mean, they do, but or a Lyft me somewhere. No, you say Uber. That's a very big positive. Now, that came at a cost. That cost was a lot of marketing spend. That's a huge cost. Look at their shares outstanding. It's up, not a huge amount, but it's still up 1.7 billion to 2 billion. That's about a 15% increase in shares outstanding. Again, not small, not big. Okay, let's go check out their free cash flow. Let's see if that looks pretty decent. Well, it's gotten better. You saw right here, it got better in the last 12 months, not including last quarter, which is much better than the previous years of free cash flow, which was negative beyond belief. All right, so things are starting to look better. Now, cash from operations is what I want to look at. Negative 860, negative 3.2, negative 3.7, negative 1.1, and a positive 780. This, to me, is how you're going to look at how is the business operating itself. Cash from operations there is growing, and it got to positive. You can spend to your heart's desire to get users, but eventually you've got to make money. And this is their gross margin, 40%. So what this means is their gross margin, this is what I'm going to look for in their report. I'm going to go really quick. I haven't found it yet, but I'm going to show you how I look for it. Gross margin means for every extra dollar of sales, how much is going to pay for overhead and how much can be used then for overhead and income taxes. So at 40%, if they do, theoretically, if their overhead stays the same and they do $10 billion more in revenue, they're going to have $4 billion more in pre-tax income. That's pretty big. We like higher gross margin businesses. Okay, now a company like Microsoft, they have 68%. Palantir, 78%. Tesla's killing it like 25%. So it's just to give you an idea of where these companies lie. I think Big Lots has about 40% gross margin, but every company is different. So let's go to this thing and let's go look up gross margin. Oh, there's no gross margin there. Interesting. Let's look up margin. EBITDA margin, margins, EBITDA I don't like EBITDA margins. I keep talking about that. Oh, poop. Well, let's see. Are their capital expenditures big? So they keep focusing on EBITDA. Let's look at their capital expenditures. Not a lot. 273 million in the last full year, and their income was 29 billion. That's very small. So EBITDA in this situation, I can understand more. I get concerned when capital expenditures are very high and people look at EBITDA. I can understand this one. 29 billion in revenue, they had 270 million. That's 1% of their revenue was in capital expenditures. Okay, I'm not worried about that. The big key here is what I like is I look at Uber and think to myself, okay, this is a company that has a great brand, very well run. They're going to have their issues because it's a very young industry. I mean, Uber's been around for what, 10 years, 12 years? I don't know how long it's been around, but it's been around and they're still growing, but it's still a very, very young industry. And my hope is that Uber ends up still being the standard going forward, but we don't know that for sure. So let's look at analyst estimates and see what they're saying. Okay, so analysts, there's 43 for this year, 28 at the final year. They're expecting to lose 23 cents a share according to analysts this year, but expect to get to $1.07 in the next 3 years. Now, let's just be back of the napkin. Multiply this by 20 for a 20 PE. The stock would be basically $21. Well, the stock's currently at 35. So that screams overpriced off the bat, but that doesn't mean the stock is overpriced, right? I'm just sitting there saying based on what analysts are saying, and analysts tend to be pretty optimistic. Let's look at revenue. Analysts are expecting $37.5 billion in revenue this year and 53 in the next three years. Now, if you look at that, that's basically low double digits overall growth. That's pretty solid growth. So we have these positives here for Uber. The question is, when can they start converting this to profitability? So let's go to our stock analyzer tool here. All right, so for those of you who are new to the channel, our software here is very awesome and great. So if you're interested in looking at the software, just please watch this video here for just 1 minute. I created the software that you're seeing on the video and behind me because I needed software for myself. This is not something that was created for other people and I use some super exclusive, expensive software. This is the software I use. And even better, we have this community of thousands of people there. And the reason it's so helpful is it allows us to eliminate the emotional fear that makes people make the bad decision in investing. The right investing is 20% about the numbers and 80 or 90% about your temperament and emotion. And that's why it's awesome to have this community. The tools help you on the numbers. The community helps you on how to view your investments and your money. So stop making those terrible decisions that all your idiot friends make when they follow companies just because they like the company. For a little over $1 a day, you can have this entire software package. It'll change your entire future of investing and your money. So sign up now, risk-free, everythingmoney.com. Check it out. All right, guys. So let's figure out the stock analyzer tool, like I said, is 1.3 million uses last year by our users. We're going to use this tool to figure out a price to pay. Now, the caveat for Uber is it is currently not a profitable business. So the stock analyzer tool is really good for profitable businesses that we can determine going forward. So this stock analyzer tool is going to assume profit day one. So how do I compensate for that? Well, I'm going to put a higher desired return here to make up for that. So this is very back of the napkin. Like I said, the stock analyzer tool is best for companies that have already consistent profit. But we are making changes to the software over time, every single day, every single week, every single month. And at some point, this stock analyzer tool will allow you to make different years and different assumptions on profitability. So let's go out with 10 years here. Let's do revenue growth of 8, 12, and 16%. Now let's see, at 16% revenue growth for 10 years, that means 4.5 times more revenue. And they did 30 billion. So it takes them 132 billion. Is that realistic? Boy, that seems high. That seems really, really high. That seems very high. So I'm going to adjust these just a little bit. I'm going to go with 6, 10, and 14%. Still high, but we'll figure it out from there. Now, profit margin. Okay, they're going to get pretty close to break even this year, but then it'll grow from there, hopefully. So let's start at a lower. Let's start with 5, 10, and 15% profit margin, and we'll do the same thing for free cash flow. Now, PE. Not going to have much growth potential from there. Let's do 13, 15, and 17, and the same with price to free cash flow. And for my desired return, guys, like I said, I put in profit here and then I expect it to be profitable day one. So I have to assume a higher desired return to make up for the profit I already gave them that they're probably not going to have. So I usually do, you can get 9 or 10% from investing in a long-term ETF. So the question becomes, what should I put here for my desired return? Oh, let's see here. I'm going to do 13, 16, and 19. Now, again, guys, this is very back of the napkin, and I don't really like the stock analyzer tool for a company like Uber, but it's just to give us an idea of, hey, can this company even justify the current price? Should I do any more research? That's the reason you use the stock analyzer tool. The reason to use it is, am I even in the ballpark? Don't go wasting your time doing a lot of research on a company, doing all this research and spending all this time when it's not even, like, let's say, for example, the stock analyzer tool says the stock is worth $3. Why would you even go do research if it's at $35? Don't even bother. And if you like the software, we're running a special, $7 for 7 days. Try it out. Check it out at everythingmoney.com. So I hit the analyze button. Okay. $10 on the low side, 42 on the high side, 24 in the middle. I will say this 42 is going to be very, very hard to get because of all the assumptions I made at the top. So for me, I'm looking at this going, okay, when it gets below 25, I'll start taking interest. Again, that's for me. Doesn't mean go buy it at 25. It's start to do more research. If you like this video, please subscribe. I appreciate your time. Take care.